Welcome back to another daily recap for Tuesday, July 30, 2024. I'm Sam Morton, and as I'm making this pre-market video to show the levels for the day, the time is currently 8:24 a.m. Eastern. The levels in the SPY that you see on this chart on your screen will be used to enter trades today in the E-mini futures. If price in the SPY hits a level here, a trade will be triggered in the E-mini futures if everything else is behaving as it should. And that is key today because this is the day before an important FOMC announcement. In my opinion, part of what makes the Wednesday Fed announcement important is the fact that it lands on the last trading day of July. And as I've mentioned a few times before, where we are in terms of timing is important. The magenta dotted line is a reference level. It's where they opened for the month of July. We've traveled up and down a lot during the month, and now here we are back near the opening price. I'm keeping an eye on this level today and tomorrow. And today there happens to be a formula-derived level right around 546. Whatever happens today, we'll come back to this chart after the closing bell to examine the price action during the open session. We'll catch you on the other side. It's about 4:45. The market is closed. Very interesting day. I'm glad I was not trading today. I'm kind of on a working vacation for the next couple weeks, and I had some errands to run, took a little trip. I was basically driving around with my wife for about 6 hours, just got back. So I kept an eye on the market via my phone, but I didn't trade anything. As soon as I finished the pre-market video and the email was sent out, I hit the road. So anyway, what would have happened? We're going to be objective here and talk about all the levels, how you would have traded them, playing by the rules. So to do so, I will adjust the levels and be right back. After 9:45, they were coming back down at 546.07. You can see. So you would have entered this trade. It's been adjusted with 5 cents, a 5-cent buffer, but they came up within pennies a minute or so later and rocketed back down, got below. So that's a signal that the trade probably happened. You know, typically they go up and give more than a base hit, but they got too close, pulled away. So that's the base hit, or that's the trade. I would have jumped out of that trade for a wash. The next level was down here at 544.81. That would not have been triggered because the first time they came down into it, they came within 2 pennies and gave more than a base hit when they bounced up within about 2 minutes. So that's a no trigger, basically a near miss because they never triggered it. Now here's where the problem started. So if you got into the trade at 543.55, say you bought one contract here, well, certainly not enough time elapsed. There's a fumble threshold down here, of course. They would have blown right through that. You would have bought again down at 542, and your average entry price would be somewhere in this neighborhood, right in the middle. And a fumble signal would have materialized when you were, I think it was around 13 points out of the money. We'll look at the tracking log. I have it figured out exactly. And immediately they continue lower. So you would have had a base hit on that combined position on the way down. Next level here at 540.47 was a pretty straightforward base hit. The first time they hit this level as adjusted, they pulled up and provided a base hit. So ended the day underwater slightly, but not too bad. I'll show you the tracking log and we can explain it there. With this new log where I'm using pivot tables, I haven't found a way to transfer text over. It's pretty much all data and numbers. So the notes that I have are in the input section. So the output, which is the report here, doesn't have the notes. So I've copied the notes over. So you can just look here. These notes here, starting with level 5, it's all L1 through L9 now instead of just the ABCD. Pretty straightforward, I would think. L5 is level 5, started with that because they went their way down. So it's a wash. You would have entered the trade, jumped out at a wash. The next one down, not entered the trade at all because it was a near miss at the operating level. Averaged in with these two levels and then had a 13-point fumble on that level, combined position. So in other words, 8 more points on the way back down. If just traded one contract, or it doesn't matter the contracts, the points are the same. And then his last level down at 540.42 was a straightforward base hit. So pretty much it for today. Thanks for tuning in. I hope you found this video helpful. Oftentimes, some of the most important things we learn are what not to do in certain circumstances. So with this strategy, I've found that if things start happening that seem to defy what is normal, it's usually a good idea to step back and be an observer. I've learned the hard way. It's not necessary to always be in a trade. Better to end the day on the zero line than put many at risk when there is uncertainty in the market. So although tomorrow is the last trading day of the month and we will probably get some increased volatility with the FOMC announcement, I'll still run the numbers and provide new levels in the morning before the opening bell. But will I trade it all tomorrow? If I sense anything unusual at the opening, I probably will not. It paid off to not be in the market today, and tomorrow could be similar. Either way, we'll talk about tomorrow and whatever happens when it gets here. Thank you and have a great rest of your day.